Morning, everyone. Welcome back to Meng by Aiman here. Right, so let's take a look at the S&P 500. Well, it did slightly by 0.14% to close at 7498 points on Wednesday session, drifting highly um, uh, on the cautious range, right? Well, surging 3% rally in the crude oil prices and also the raising 10 years bond yield, right? Also created a headwind for the broader equity market, while the investors largely stay on the sidelines ahead of the critical or the significant post-market earnings from the mega cap tech giants like Alphabet and also Tesla. So near-term sentiment is heavily anchored to corporate earnings performance, and it would give some spark to the market also, right? So if you look at the China A50 futures, well, experience I would say a flat, right? A quiet session on yesterday's session, dipping by only 0.04 percent to consolidate near its high level. So following the early of the week breakout, the domestic equity took a breather as the mixed performance across the mainland Shanghai and also the Shenzhen indices, reflect the selective profit taking in the high valuation tech names alongside the continued positioning ahead of Beijing's key economic decision. So I believe if the positive sentiment to follow through, well, it likely to clear all the 50,500 and also the together with the moving average levels right now. So if you look at the WTI crude oil futures, well, it surged over 2% on yesterday's session, well, to settle at somewhere around $87, hitting the 6 weeks high as the escalating Middle East hos- um, tension reached its new peak, right? So the if you see here, the prices rallied sharply after the Trump warned the Washington would destroy the Iranian bridge, and also the power plant for every ship targeted in the Strait of Hormuz, while the parallel threats from the Houthi rebels in the Red Sea heightened the fears of a dual strait energy supply chokehold. So chart-wise, I think it is pointing higher now, and I believe the positive sentiment should follow through at this juncture to test the $90 level. Also, if you notice, the SMA line has crossed the uh, has crossed below here, which also signals short to medium term momentum to come back or to return. Right. Also, if you look at the our market, the Malaysia market, right? The FBM KLCI dropped by 0.52% or to close at 1711.37 points on Wednesday's session, while the FKLI mirrored the retreat of the 0.2% deep, right? So the local burst the third consecutive session yesterday uh, of the broad-based profit taking as the investors lock in gain following the index strong run from the 1655 level recently up to 1753 points. So I think sentiment was further dampened by the lingering geopolitical tension as well, and also the rising crude oil prices alongside with capital pivot back into the North Asian tech counters. But however, I believe at this juncture, well, here, right, this is just a healthy pullback within a uh, broader view. Well, bullish uptrend still intact at this juncture, crossing above all the uh, holding above all the moving average right now. Well, for the heat map, right, the sectorial heat map, well, it highlighted here, well, widespread profit taking across the core index heavyweight, as the major, I would say, major FI, right? Like the Maybank, Public Bank, right? Um, and also tenaga way down the broader market. However, selective buying in the local market, the FVM is providing localized support with the industrial metal like pressed metal right here up by 1.9% yesterday, and also tech counters like Vitrox, right? Up by 0.89 percent, and also Franken by 1.41%, showing a resilience against the, red uh, sea of red, right? So, for our Malaysia trading stocks for today, right? So we have Red Hill Utilities. So the stock is on its pending breakout formation at 2.05, 2 ringgit and 5 cent level on a strong volume. With that, we expect momentum to keep bullish and the stock able to propel higher to test the next resistance at 2 ringgit and 15 cent, followed by 2 ringgit and 25 cent level. So if the stock to clear below this 1 ringgit and 95 cent level, this could reverse the course and trend lower below, together below the 21-day moving average as well. And also next we have the next or the Gang next change, right? So the counter or the stock is experiencing a breakout at 46 cent level, right? So if the stock to remains bullish, right, we expect the price to reach 50 cent, and the second resistance at 54 cent level. Yeah. So do keep an eye at the 42 cent level for any attempt of reversal right now. So we have one pending breakout, which is Red Hill Utilities, and also one breakout stocks, which is Dagang next change or the next. So do keep this both of these stocks in your watch list, and let's monitor closely. And for the FCPO, right, well, it rebounded by 0.24% in Wednesday session, standing above the key technical support following the Thursday's minor pullback. So I think the market found the underlying strength from the MPOC latest monthly outlook, which also project the August prices, right, to trade between 4.4 to 4.65 per ton. Well, the bullish sentiment was also underpinned by the elevated, I would say, oil prices, which also linked to the tension and also the recovering oil extraction rate, offsetting the broader global demand softness. However, at this juncture, right, since the price is still hovering below this 4,700 level, we still keep our negative trading bias intact, unless it breached the 4,700 ringgit level, then we shift our sentiment to a positive sentiment. Well, at this juncture, we're still targeting towards the support of 4,390 level. Right, so that's all from me, and I pass the floor to Siang. Thanks, everyone, and happy trading.
Thanks. Morning, everyone. Let me continue with results review note on Ecoshop. We are having a buy call with target price of 1 ringgit 82 cent. Ecoshop reports its FY26 results yesterday, year end is May, and we consider the result as within expectation despite the numbers counting for 102% of the forecast. That's after considering the one-off positive tax adjustments recognized in the fourth quarter. Overall, if we look at the numbers, FY26 revenue rose 5% to 2.9 billion after Ecoshop added 91 net new stores during the year. Same-store sales growth was negative 10% as volume took a dip after the price increase that took effect in April 2025. Having said that, we saw a good gross margin expansion by 5 percentage points. That's mainly thanks to the price hike that I mentioned just now. Apart from that, income reclassification favorable forex and the higher contribution of house brands products have also helped to support the gross margin expansion. So this more than offset the higher OPEX on higher minimum wages, and on top of that, the bonuses and incentive to lift staff productivity as well. And together with the tax benefit I mentioned just now, we saw a 24% jump in FY26 core net profit to 265 million. On a Q-on-Q basis, fourth quarter sales rose 4% to 773 million, as same-store sales growth improved to negative 2.3% from 12.9% the previous quarter. And this is the best showing in the last 5 quarters after the price increase. To explain the recovery, apart from the low base, effective marketing efforts and supply normalization from the shortage or disruption situation earlier on were also the catalyst driving the same-store sales growth recovery. And with gross margin continue to expand from the elevated level, we saw a 2% earnings growth in fourth quarter to 73 million. In terms of the outlook, management guided that the same-store sales growth recovery has sustained into first quarter so far, seeing positive numbers in the first 2 months. This is well supported by a solid pickup in transaction count, and with the outlet expansion plan to add 100 stores going forward, we believe the top line growth momentum will be more exciting in FY27. Margin-wise, management is guiding for 33 to 34% in anticipation of cost challenges coming from the Middle East geopolitical tension. But that is actually a bit higher than what we assume in our forecast. Having said that, we think the rising cost environment should also help Ecoshop in regaining their price competitiveness, as non-dollar stores are likely to pass on the higher cost, whereas Ecoshop, given the flat price store model, will maintain its pricing. And gross margin downside, we believe, will be cushioned by the efforts to optimize SKU and the growing sales contributions from house brands. So post results, we make no material changes to our earnings forecast, and target price is also slightly adjusted to 1 ringgit and 82 cents, which implies 32 times forward PE, which is at a discount to other large cap consumer stocks. We continue to like the stock. We maintain our buy call, and target price is now 1 ringgit 82 cents. That's all from me. Let me pass on to the next speaker. Thanks.
Thank you, Wei Siang. Let me continue with results review on CTOS Digital. This is the first half of FY26 results. Revenue rose about 8.6% year-on-year to 169 million. Core PATAMI up 16% year-on-year to 42.6 million. These accounted for 42.1% and 43.3% of ours, as well as a consensus full year estimates. Now, typically, first half make up about 40 to 40% of the full year earnings based on historical trend, and we expect second half, a stronger second half numbers to make up for the year as usual. Now, second quarter, the EBITDA margin improved marginally by 20 basis points, supported by 43% growth in the international business, as well as some cost-saving initiatives, which partially offset by additional OPEX from cloud migrations and IT infrastructure modernizations. Now, the associate contributions in the second quarter dropped slightly, about a few hundred thousands. Basically, this is a result of a disposal of Experian back in December 2025. They declared second interim dividends of 0.7 cents per share. This is again a marginal up from 0.65 cents per share in second quarter of 2025. Now, in terms of the outlook, I think apart from the regulatory tailwind from the Consumer Credit Act 2025, which took effect in March, that provided CTOS an expanded data pool. especially from the buy now pay later issuers, as well as penetration into the underserved markets like the thin file segment. They also embark on various new collaborations, as well as rolling out of various new digital and analytic products, both in the key accounts as well as the consumer segments, to deepen the partnership and growth strategies into 2026 and 2027. Now, on top of that, the cost discipline to drive the cost to income ratio from 46% last year to 42% over the next 3 years would also provide supports to the earnings growth. Now, separately, they also announced they propose to dispose a 10% stake in Juris Technologies at a valuations of 500 million. 10% imply 50 million profits in this disposal. Valuation wise is on at about 16.7 times trailing PE for Juris Tech versus CTOS 16.5 times. But the 500 million valuations for Juris Tech as a whole is actually above our current valuations of 461 million in our numbers, as well as 420 million valuations at the time of acquisition back in December 2021. Now, the disposal is expected to generate a one-off gain of 1.6 million, which is expected to be completed by end of the month. This would otherwise reduce CTOS share of associate profit by about 3 million per annum, which equivalent to about 2.4% and 2.3% of our next 2 years' earnings. Now, the proceeds will fund a special dividend of 1.07 cents per share, with the remaining 50% of the proceeds allocated for share buybacks program. Now, the disposal forms part of CTOS strategy to monetize its non-core assets while paving the way for a potential further exit of its remaining 39% stake via an IPO or share sale within the next 18 months. Now, they retains call options, should further monetizations not materialize. Now, at current price, we think, the below mean valuation is attractive, given its strong cash flow generation, as well as its yield on offer of 6.4% in FY26, including the special dividend, as well as a resumption of growth path in FY26. On top of that, the ongoing monetization strategy to unlock value should provide further upsides. Hence, we maintain our buy call with a slightly lower target price of 110 cents. This is after taking into account the latest valuation for all the associate stakes, which provides 73% potential upsides. Thank you for listening, and we'll pass on to the next speaker.
Hi, good morning, everyone. Let me just share my screen first. Okay, so today we have a trading idea report on an M&E company called West River. So West River provides end-to-end electrical engineering and air conditioning, mechanical ventilation, SEMV solutions in Malaysia. So it has Class A and G7 accreditations that allow the group to undertake projects of unlimited value, while its in-house manufacturing capabilities of electrical panels and distribution boards enhances quality control and cost efficiency. So we believe the company is well positioned to benefit from the expansion of Malaysia's M&E engineering services market, which is projected to grow at a 12% CAGR between 2025 and 2029, driven by industrial infrastructure and data center investments, according to Broadcast Associates. So West River growth prospects are underpinned by its 180 million outstanding order book as at end June 2026, equivalent to 1.6 times FY25 revenue, and providing earnings visibility through first Q27. So the group's 600 million tender book, coupled with its historical win rate of 10%, should continue to support order book replenishment. Okay, so notably, it recently secured its maiden 25.2 million DC contract in Johor Bahru and is currently bidding for several hyperscale data center projects, which its margin is typically 2 times higher than conventional projects. Securing additional contracts could potentially lift DC contribution to 20% of its order book and improve group margin. Meanwhile, West River newly acquired TNB certification for 33 to 275 kV substations position the group to tap into TNB expanding capex and participating in several TNB high voltage tenders. Okay. So the group is also venturing into renewable energy business via the acquisitions of Ace Hydropower and Excel Hydropower. So the group is targeting 2 hydropower power purchase agreement projects with capacities of 7.2 megawatt and 4.5 megawatt to generate recurring income stream starting from FY30 onwards. Okay. So with this, we forecast a 3 years earnings CAGR of 31.3%, underpinned by a strong order book, sustained replenishment from its sizable tender book, and improving margins from a better revenue mix as it secures small DC substation and data hall projects. Okay. Okay, so all in all, West River is an overlooked mechanical M&E player making inroads into Malaysia's booming hyperscale DC market, where projects command 2 times higher in terms of margin compared to its conventional jobs. So the group has also secured TNB accreditation, enabling it to participate in higher value substation projects. In addition, it also ventured into hydropower, and the earnings the earnings in terms of recurring income will begin FY30. So the company is just trading at 6 times FY27 FX cash PE. We believe West River remain one of Bursa Malaysia's cheapest M&E stocks at the moment. Okay. So we are ascribing a PE of 13 times, which is -1 standard deviation from Bursa Malaysia Industrial Production Index 10-year PE onto its FY27 F earnings. We derive a fair value of 45 cents. So as you can see in the peer tables here, these are its peers. They are all trading in between 12 to 20 and at the average of 16 times. So we are giving 13 times due to its smaller market cap. But as a group, prove its improving margins on par with others. One day it might trigger higher rating. Okay. But at the moment, because we see there will be a restart of growth, year-on-year growth for the company. So yeah, that's how catch our eyes. And with a fair value of 45 cents, that translates to an upside of 70% from its current share price of 26.5 cents. Okay. That's all from us today. Thank you for dialing into our Morning Kappa at 8 Facebook live show today. Hope to see you guys again tomorrow. Thank you.